Welcome to the Green Zone Podcast, the show that teaches oil and gas executives how to take command of their finances and live in the green. Your host, Jeff Green, from Green Financial Group, will be your financial guide, all while giving you a tour of the most beloved and best-kept secret spots around Houston, Texas. Now, on to the show.
This is the Green Zone with Jeff Green and Lauren Smith of Green Financial Group. I'm Patrice Sikora. NASDAQ hit a record. Blue chips, S&P 500 have recovered everything they lost in March, but COVID-19 is still with us. So, Jeff, you're the guru here. How are your forecasts looking now?
Oh gosh, that's what. Now you put me on the spot. So I'll tell you about my forecast, and I'll tell you what they're worth. They're worth exactly what you're paying for them right now, which is nothing. So I'm not a big forecast guy, but everybody wants to know, hey, Jeff, what's your opinion? What do you think's going to happen, with the market and this and that, and these analysts give, we're going to talk about the S&P. So all the conversation today is going to be guided around the S&P 500 today, just for clarification's sake. So what's your forecast, Jeff, for the S&P 500? Well, if you paid any attention to what we have said in the past about our forecast, at the end of 19, we made pretty much the same exact forecast at the end of 20. The strangest year of our lifetime, and it's not even over yet. So compared with most other analysts, we had a pretty bullish call then. And when the market hit a pre-COVID peak of 3386, that's S&P 500 in mid-February, we were looking not bullish enough. And then the bottom fell out of stocks, fell out of the economy. We're struck by COVID-19 and overly strict government shutdowns. And the S&P 500 bottomed at 2237 on March 23rd. Now, if you're playing the home game of the Green Zone podcast today, don't worry about writing all these numbers down. They're not important because I'm going to get to a point to it here in just a minute. But when that bottom came, and I've said this repeatedly, the market was pricing in an 80% drop in corporate profits. In other words,
right,
when the S&P 500 was at 2237, it was basically saying, hey, corporate profits are going to be down 80%. And that was from the year before. So that made our call of a 3650, which is what our call was for 2020 on the S&P 500. That made it look pretty obsolete and like it was never going to come around. So then about 7 weeks later, on May 8th, stocks had recovered back to 2930. And we thought, well, 3650 was probably still obsolete. So we lowered it down to about 3100. Still bullish, but just a little bit lower. Mm-hmm. Then only 4 weeks later, the S&P 500 had blown through our updated year-end target and was sitting at 3194. So, and here we are. Today is September 1st, and it's 1:05 p.m. Central Time. The S&P 500 is sitting at 3516. So I just want to make sure we're clear on that.
Right.
So we're looking our target up to 3650, right where it was. So through all of this, the key lesson here is you can't time the market. It's a foolish thing to do. So imagine if you it's February 15th, of 2020, and we're being told that the world is about to be hit by a widespread virus that there's no known cure for, no known therapy, that the governments were going to react by shutting down the entire economy, that U.S. real GDP was going to drop at the fastest rate for any quarter since the Great Depression.
That's right.
And then you had to make a choice about how you would allocate your investments. What would you do? Lauren, if they're giving you all that fact, what would you do? Go to cash. That's what I would do. If somebody painted the most doom and gloom picture of, that one could imagine, I would go to cash. So
that's if you want safety, though. That's if you want the safety.
Yeah, but here's my point. Thank God I can't see into the future. Thank goodness my crystal ball gets fuzzy right about 8:30 when the market opens, and I really have no clue what's going to happen. Because here's what we told our clients. Stay put. don't do anything. We didn't know all of this was coming our way, right? We didn't know a global pandemic, government shutdowns, restrictions, etc. We didn't know. All we knew was we owned quality. And what we do for our clients, we own typically dividend paying stocks so that when we go through corrective periods, we get paid to wait. So we get to collect our dividends while we're waiting. So we had our clients do absolutely nothing.
How do you keep your clients calm at that point?
Well, it's a lot of hand holding. It's a lot of phone calls. I'm going to tell you, during that time, Lauren, what was it? March to
end of March, May. Beginning of April.
Yeah. I guess through really into March, let's call it March through May. Mm-hmm. I don't think I've ever worked harder in my entire life.
A lot of long days, a lot of phone calls.
Yeah. Mm-hmm. A lot of long days, a lot of phone calls, a lot of saying the same thing, basically what we've said here, and nothing fun. I got to remember, January and February were two of the strongest months that we had seen economically speaking, and nothing really changed other than this virus came out. I'm not underscoring that in any way, shape, or form. Naturally, on shutdowns, corporate profits were going to fall. But we also knew when economies opened back up, corporate profits would begin to come back around, and we would see stock prices come back around. So in hindsight, we know that obviously it was better to do what we advised our clients to do, which is sometimes exercise the hardest, the most rarest commodity on Wall Street, which is patience. And that's what we had our clients do.
What are you telling them now? I mean, looking forward, the Fed is saying they're going to continue this easy money policy for quite some time. And the market's doing fine, and there seems to be a recovery, but come on, this isn't going to be a smooth recovery. It can't be.
Well, you got to consider there's two recoveries going on right now. There's a stock market recovery, and then there's an economic recovery. And the stock market recovery you're seeing, and again, if you go back and listen to earlier podcasts, I'm repeating the same thing I said months ago. You're going to see a V-shaped recovery in the stock market, which we are seeing. And you're going to see more of a U-shaped recovery in the economy. And they're two different things, although obviously very closely related. But you're seeing that U-shaped recovery in the economy.
Right.
But the reason you're seeing that V-shaped recovery in the stock market is because it is a discounting mechanism. It is looking forward. It is anticipating the future. It saw that corporate profits never went down by 80%. That was a fallacy. So it overreacted, which stock markets typically do. And it overreacted in the downside. And so, Patrice, that's why you're seeing a lot of this upside come. And nobody, in fact, I just had the question posed to me today by a client, Jeff, I don't get it. Why the disconnect? And it's simply that. It's the stock market is anticipating a good recovery going into third, fourth quarter.
But what if the economy takes longer? Because we are not seeing the bounce back in smaller businesses especially. And a lot of states still have pretty strict lockdowns.
Yeah. So here's the thing with that. And this is, and I've said this before too, and it's a very unfortunate thing, but it is the reality of the stock market. The mom and pops. So you got Home Depot. Okay. Right. Home Depot
is doing very well.
Well, why? You know what the
Everybody's
reason
home.
why, Patrice?
Yeah.
Well, because nobody said you can never go to Home Depot.
That's right.
Did they?
Yes.
The government didn't say, hey, Home Depot, close your doors. Nope, didn't do that. But you know what it did do? It told the mom and pop hardware stores they had to close theirs.
You're right.
So when your competition goes away, it makes business pretty good for you. So while you asked the question, that's why Home Depot is doing so good, and many other stocks like that is because their competition was eliminated by the government.
Do you see bankruptcies coming out of this for the smaller people?
Absolutely. We've already seen it. And it's so, we've been on here, Patrice, talking about this since it began. And I have preached buy local, shop local, support your local businesses as much as you possibly can. And we've done that. every chance we get, because Home Depot ain't going bankrupt. Walmart ain't going bankrupt, but some of the mom and pops are.
Yeah.
And it's highly, highly unfortunate. And it makes me sick every time I think about it.
Well, this brings me back to the Fed then, and their easy money policy. Where do you see that taking us?
It's good and bad. It's cheap capital out there, right? So I just bought a new home, got a great rate, right? So good for me. Many people out there are refinancing at unbelievable rates. We're helping a lot of clients do that. At some point, we're going to pay for this in the form of inflation. Inflation is going to come our way. And all with all the stimulus, the lower rate, et cetera, inflation is, in our opinion, going to come our way. Now, what do you do when that happens? What we do for our clients, for who it's appropriate for, what does well during inflationary prices?
Gold, more hard assets in that type of situation.
Yeah, gold, silver. So Lauren, buy your jewelry now, because it's only going to get more expensive later.
Don't have to tell me twice.
So, and you're already seeing gold prices increase significantly. Yeah. That is in anticipation of higher inflation.
Okay. So this is like the canary in the coal mine. It's telling us it's coming.
Yeah, exactly. Yeah. And you'll see, and that's, by the way, silver doing well. And
actually, silver's been on something of a tear too, hasn't it?
Yeah. We have a lot of clients saying, "Hey, Jeff, how about gold?" And I'm like, "Well, yeah, I'd love to own some gold right now, but I'm a little scared to go out buying it at the moment, just because it's gone on such a tear, and in anticipation of a pullback at some point, and hopefully an entry point."
All right. What do you see about tech? I mean, that seems to be just exploding right now, and I really am not quite sure why, because it's not tied to COVID.
Well, to some degree it is. And so through COVID, we all learned that we don't necessarily have to go to the office, right?
True.
Or go to the office nearly as much. We don't have to go to the store to buy this or that. We've always had Amazon, and that's nothing new. But maybe we don't have to meet face to face. We can go on Zoom. Maybe we stay at home, and technology that we are seeing utilized during COVID is much greater than what we saw pre-COVID. Now, I say that, and this is something that somebody had told me at one point, and it's hold true, and it will hold true every minute of every day. And that statement is this: technology has never moved this fast before, and it will never move this slow again. So it is an ever increasing output of technology and new technologies and resources that during our lockdown, we have become more familiar with, we have utilized more. And there we have realized, I mean, how many Zoom meetings did you do prior to COVID? I mean, I didn't do any. I hadn't done one. Now I've done a gazillion of them. So we're learning to do new things via technology.
Now, you're saying technology is never going to be slower than it is now. It's just going to keep ramping up. How can we keep up with it?
I just keep having kids and keep hiring younger generations. That's all I know, because it outpaced me a long time ago.
All right. Taking this all together, we were going to talk about timing the market. Is it a good thing? Is it a bad thing? Talk to me about that.
Yeah. So we'll tie all this together back to my previous comments, where I was spitting out all the numbers that I had that were wrong. You can't time them. You cannot time the market, but certainly you can see better times than others to be invested. Think about being on a boat out in the middle of the Gulf. Okay. You got Hurricane Laura barreling down on you, and you're in this boat. Certainly you can see that there's a better time than then to be in a boat with Laura barreling down on you. So that's how we view the market, kind of as a whole. And then we look at it at the macro level and then break it down to the micro level. We can say, look, not a good time to be out in the ocean. Certainly not in this boat, this little bitty boat, but maybe if we're in a lot bigger boat and we skirt this hurricane a little bit, we're going to be okay. So that's what we mean by we don't time the market, but certainly we identify better times than others to be in the market, and certainly better time than others to be invested in certain equities.
You got to have an appetite here, though, an appetite for some risk.
That you do. And, I would say currently, in our opinion, markets are a little frothy at this point. And again, I believe we're in a new bull market. I think we have years left to run on this bull market. I think we're going to be enjoying gains for a while. Ain't going to be straight up. Mm-hmm. And in the short term, and I mean over the next month or two, we may see a bit of a pullback. Mm-hmm. Might be a buying opportunity for some, might not. But, it would not surprise me to see a bit of a pullback. But again, I've been saying the same thing for a couple of months anyway.
Well, if you think about it, if the economy is going to at least hold steady and slowly grow, that does set the stage for a great bull market.
Sure. Absolutely. Corporate tax rates, some of the deregulation that we've seen, some of the other things, the economy and some of the regulations I'll say out there are favorable to a strong economy and a strong stock market.
Mm-hmm. And then I'm going to throw in one other question here. The labor market. Where do you see that going?
Well, we're seeing, I guess was the last first part of this, we're in September. So it was in early August, I guess. You saw everyone was predicting job losses and we saw job gains. And I think you're going to continue to see job gains, but it's going to be a long, long time before you see 4% unemployment again. And the reason being, Home Depot might be hiring, but the mom and pops, they're not. And that's sad. And the restaurants and bars, which are a lot of workers, they're at 50% capacity, which means they're running at, they're allowing 50% of the customers in, which means their staffing is 50%. So they haven't hired back everybody that they've laid off.
Yeah.
And it's going to be a long time before that happens again. So unemployment will remain high for some time.
And I've got to wonder whether or not some of these people, I'm sure not all of them, but some of them may have to say, I've got to turn around. I've got to get another career. I've got to change what I'm doing. And maybe they'll end up getting into tech.
Yeah, this is a cycle that happens throughout our lives anyway. This one's just been thrown in our face to some degree, and the changes are normally slower than this. Manufacturing, steel making, et cetera. Those have evolved over time. Making cars, used to be all humanized. It was a human screwing in all the bolts. Now it's machines screwing in the bolts. So, but that was a process that took time, and those laborers and that part of the workforce found new work and new roles. But it was a gradual process. This has been a very quick process of that, and it's going to take. That's why, again, it's going to take time for the labor market to adjust and unemployment to come down to where we were before all this started.
Eli Whitney's Cotton Gin has nothing on this. That's for sure.
Not at all.
All right, one big last question, Jeff. Where do you see us?
This is your third last question.
I know. That's okay.
That's okay.
Where do you
I got them all. I got answers for everything. It's Ask Jeff Anything Day, so go ahead.
I'm not even going to go a year out. Let's go 6 months out, because that's going to include the elections. What do you forecast?
So here's what we're doing for our clients that it is appropriate for. We want to err on the side of caution going into the election. There's a big unknown going into the election. And I'm not even talking about which party wins. We may not even know who wins until well into January. There's just so much uncertainty out there. What we want to do for our clients and what we're recommending for those that it's appropriate for, we want to be somewhere between 30 to 50% in cash. And when I say cash, I mean cash alternative that's paying us a little bit of interest along the way, but something very, very conservative. And the reason we want to do that is because you can't get out of the way of a falling market.
Mm.
It's just it goes down too quick. The election is going to produce one of three things. A, the market's going to go down a lot. B, the market's going to go up a lot. Or C, it's just going to kind of keep doing what it's been doing. So if I raise enough cash, if I get defensive enough, then I don't have to worry about the market going down if that's what happens, because it's going to go down faster than I can get out. And if it goes up, I'll have time. You can't get out of the way of a falling market, but you got time to get into a market that starts to go up. And if the market kind of just keeps doing what it's doing, then I got time to get back in. So 6 months, don't know, but I'm going to be cautious going into the election. That I know.
All right. How can people get in touch with you if they really want to sit down and say, Jeff, I want to talk about this?
Talk about your crazy forecast, Jeff. No, the website's greenfinancialgrp.com. And the phone number 713-244-3030.
And that is The Green Zone with Jeff Green and Lauren Smith of Green Financial Group. To be notified of new episodes, make sure to subscribe with the subscribe button on this page, and you can share with friends and colleagues using the share button. I'm Patrice Sikora, and we're going to talk to Jeff and Lauren again real soon.
Thank you for listening to the Green Zone podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views and opinions of Green Financial Group. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors, Inc. Green Financial Group is not a registered broker-dealer and is independent of Raymond James Financial Services. Jeff Green is the founder of Green Financial Group and is a registered principal of RJFS. The Green Financial Group is located at 6363 Woodway Drive, Suite 625, Houston, Texas, 77057, and can be reached at 713-244-3030. Raymond James is not affiliated with and does not endorse the opinions or services of his guests.